Rates jumping from 3% all the way up to 7% has created a lock-in effect where homeowners are simply just staying in their homes regardless of trying to sell it, not getting the price that they want, and then basically rage quitting their listings, taking them off of the market, keeping them stuck, and it's preventing the market from moving forward. And we're just one labor crisis away from this all falling apart and the economy really slowing down further. Let's dig into the data and what it looks like. So look, sellers are sitting on low interest rates. A lot of them, over 80%, are below 6% mortgage rates, and this is creating a lock-in effect at this time. Here's a chart from Reventure. It's the record low home buyer demand to start 2025. This is existing home sales, and as you can see, the number of existing home sales has dropped from 2021 down about 40% to $4 million on a per annual rate. And the problem is when we have this lock-in effect where these homeowners have low interest rates and they have to move to another house that is thousands of dollars more to make that move, they stop upgrading, they stop downgrading their homes, and they stop relocating close to family. The death, divorce, disease, the three Ds as well, are the things that really will trigger the moving. But these want to moves, not have to moves, are just causing the market to sit still in a lot of cases. And the problem is with this is if a seller has a great rate and they don't want to give that up because they have an affordability problem themselves, then they end up just staying in that house. And 70% of sellers who do sell then go to buy. So that's pulling a ton of buyers who really do want to move out of the market. And this is a huge problem for demand driving forward. And that is why we're seeing these existing home sales really struggle going into this year, and especially into the end of the year as we start experiencing seasonality. So this is especially true in Florida, which is where I'm located, because the relocations have dropped about 80% from the peak years as well, and people are actually relocating back to where they came from. So here's information that basically shows your monthly mortgage payment. This is a great chart because you can see here in 2021, that is when in 2022, the Fed started raising interest rates on the Fed funds rate. They increased it, nearly 4% in a short period of time, and that spiked the cost of buying with a mortgage. So you can see the existing homeowners are paying like $1,500 a month, which is fantastic. And if you were to buy that same exact house, you would now be paying $2,500 a month, so an extra $1,000 a month, which is a significant increase in their monthly payment. And that is a huge problem, creating this stubborn lock-in effect. And I totally understand this. If you're a seller and you own your home, why would you sell it if you have a 2 or 3% rate? Sellers can't afford to be stubborn if they don't have to move and it's just a like to have, so they can list it on the market and see and test it and see if they can get what they want. Obviously, this is very frustrating to realtors who spend thousands of dollars trying to market the property and then have the seller just remove it right away after they don't get the price that they want. And generally, the price that sellers want are unrealistic because their house isn't upgraded or it's next to a new construction community and they don't have the upgrades or the incentives to be able to compete with somebody else who can buy down their interest rate to the 3 to 4%, like many of the builders are doing to get their inventory to continue moving. So this is a really great chart. This comes from Compass. This is data for listings in 37 states where Compass operates. This says a percentage of withdrawn listings is a percentage of new listings on a monthly basis. So you can see as a percentage of new listings, 42.3% of listings are actually being pulled off of the market. Obviously, this generally happens during the holidays. You can see over here that whenever the holidays hit, people do pull their listing off the market and then list it in the new year because they're unable to sell. They don't want to be showing the house while they have people over. But we're seeing a spike already early in the year in August and September. And this is basically what I'm referring to, which is the rage quitting with the withdrawals and the cancellations and the expireds. We're seeing record number of expireds happening right now. And that is actually the reason why we're not seeing higher inventory than we would this time of year. We've actually seen inventory drop about 10% simply because sellers are getting frustrated. They can't get the price that they want. They're starting to do the math, realizing, hey, if I buy this new house over here, I'm going to have to basically increase my payment by 80, 100% to purchase the new home, or it's the same amount of money and I'm downsizing. So it's not exactly a great trade for sellers right now, just to trade and find another house to buy. And who's driving the market right now? This is a fantastic chart from Fortune, age distribution of home buyers and sellers by generation. So you can see the sellers in the dark red, the buyers in the light red. And you can see that the younger boomers represent the majority of the sellers, and they also represent the majority of the buyers from this segment. And the Gen Xers right behind them are competing for homes. But I mean, the older millennials, the younger millennials, and the Gen Z, I mean, they are loaded up with student debt, credit card debt, car loans, all this stuff that's preventing them really from an affordability standpoint from being able to get into this market. So not only are sellers who are older generally are locked in, but Gen Z is locked out. And the young boomers right now are driving the market, and this next chart will show you that. And you can see the repeat. This is the median home buyer age. The repeat buyers are 61. Look at that, up from 36 in the 1980s. All buyers, the median age of a home buyer right now is 56 years old. It used to be 31. And the first time home buyers jumped from 29 years old to 38 years old. This is a massive, massive change. And you're talking about an entire decade of first-time home buyers that are basically locked out of the marketplace because they can't afford these prices at these rates. My preference is actually for prices to come down, not for rates to come down. However, the Fed is going to do whatever it can do to keep the market going, along with FHFA director Pulte. He's obviously a home builder. He's going to do whatever he can to keep the market moving. That includes lowering rates and finding incentives for buyers to buy this, in my opinion, overpriced junk that they slap up and they try to sell for an insane price to the next generation. And I think, the best thing that can happen is prices coming down. This is why the younger generations are priced out. There's obviously a housing bubble. This is home price to median household income ratio. We are past our previous 2008 housing bubble in terms of this ratio. And ultimately, when this happens, the market freezes, right? So older people are locked in with low rates and young people are locked out with high rates. It's a massive issue. Now, here's the data just to kind of look at this in a historical standpoint. The national data basically shows there is a slowdown. Days on market has increased 50 days to 60 days in August, showing that buyers are slowing. So this is not just a regional issue where we know the South and obviously Texas and Florida are leading the pack. Arizona is starting to have some issues. California, Colorado. Definitely, there's certain areas that overbuilt, had way too much speculation over the last few years, and then 2020 hit, and the rates started going up, and it just kind of crushed the market. And this is starting to show up all across the country now. And we do think that the Northeast will start to see a little bit of a slowdown just because they didn't have as much speculation or new construction building. I don't think will cause them to not have any impact. Obviously, will impact them a little bit. But you can see the days on market is going up. The price reductions are going up. The month supply is going up. And it's across the board an issue. Now, a lot of people say, well, there's not going to be a crash because homeowners have a ton of equity. That's what they said last time too, right? And so it's not that homeowners don't have a lot of equity, it's that they start to lose their jobs, the prices fall, over a couple of years, and there's starting to be foreclosures that we have a backlog of basically 5 years of foreclosures that really weren't processed that should start to get processed if the government doesn't step in of Q2 of next year because of all their loan loss mitigation programs. But median price just started turning negative across the board, across the United States. And when we look at this compared to 2008, we had a 10 plus month supply of inventory because the banks had to offload all their inventory with their tranches getting downgraded from the rating agencies. And today we don't know what's going to crack the market. My guess is as good as yours, but I do think that the labor market's going to crack and that could cause some issues, or the bond market's going to crack and spike because of our deficit issues as the US government. But right now our month supply is 4.6. So there's no reason for a lot of people to sell if they're locked into their low rate. There's a lot of people who want to sell, but we also have the silver tsunami coming through where we were sadly going to lose about 15.6 Americans. Usually the boomers are older over the next 10 to 15 years here, according to a Harvard study, and those houses will come available that they own, and a lot of them will be sold through the estate. And that'll add to the inventory. And meanwhile, the younger folks are priced out. Another concerning point that we're seeing is that roughly 1 in 7 US homes that are purchased are getting canceled along the way. You can see 2025 is much higher than the prior years. And in Jacksonville, Florida, we're actually seeing a cancellation rate of 25 to 30% depending on the month this year. So it's almost double what we're seeing here across the board. And that's because 30% of the purchases in Jacksonville have been from investors, right? And so American Homes for Rent, Progress Homes, Invitation Homes, these large single family rental aggregators, they come in and buy and sell. They're actually starting to dispose of a lot of their inventory, not all of it, but they're starting to sell off the parts that they don't like and add that inventory back into the market. And right now they are net sellers in our specific market, but it's something to watch, right? Because cancellations mean that these properties come back onto the market. It's very frustrating for the sellers, and they're unable to get the price that they want. We're starting to also see, this is the foreclosure filings in the US. This is data from January 2018 through August 2025. The filings are starting to move up. So in September 30th, the FHA loan workouts, which I think are the next subprime mortgage crisis, these FHA loans that are at the 580 credit score and have a bunch of workouts where people have just been lumping their payments onto the back end of their loan versus going to foreclosure for years. They've been doing this for years at the taxpayer's expense, which is kind of crazy. They made it a lot more difficult to be able to do that process as of September 30th. So I think that will add some to the inventory as it gets processed through, or it'll be sold off to some sort of hedge fund off market and will be turned into a rental of some sort. But the foreclosures, I think, will start to tick up moving forward as we do see prices fall here in Florida and across the country, and the consumer continue to get under stress. Another indicator that we're seeing is that August luxury home sales have dropped to their lowest level in more than 10 years. You can see the number of luxury homes, this is according to Redfin, is just kind of fallen off of a cliff. So, the high-end buyers are starting to pull out and be a little bit more careful of what they're seeing there. Now, what's happening on the ground in the South specifically, this is where the majority of the pain is. You can see the southern states, Texas, Florida, Oklahoma, across the board, you can read those. But the new homes for sale are stacking up to a level that is higher than the 2008 crisis, despite all of their incentives that they're offering, right? They're buying down your interest rates, they're giving you free refrigerators, etc. But it's getting worse every single month, and a lot of the builders are just simply stopping projects or trying to. A lot of the times they do have to finish their project once they've broken ground and they've started the financing and got the crews out there. But a lot of the new projects that were meant for the, phase 3, phase 4 are stopping, and they're just going to wait and see and try to build a house one at a time versus all at the same time. And so they're being really careful on how they do it. Now, as we mentioned, it's very regional, so you want to look micro before you kind of talk about the macro. And this is a good rule of thumb because every market is so different. Even throughout Florida, there's some areas of Florida that are doing just fine. There's other areas that are just getting completely crushed. Again, it depends on how much speculation there was for that area from an investor standpoint, from an Airbnb standpoint, and from a rental standpoint. All, it's a huge problem and why people would migrate to that area. So, and then secondly, the new construction around that area, is there more land to build a similar type of product to compete with yours? But you can see that 4 of the 7 major cities in the United States, according to Realtor.com, are in Florida. And so is Miami, Orlando, Jacksonville, where I am, and Tampa. We're also in Tampa as well. These areas are really, if you're a buyer, this is fantastic news because you're getting some relief. And if you're a seller, you need to be real about what the price is that you can get for your home and probably move quickly, because I don't think that this is just a short downturn. I think we're definitely in a correction already, which is a 10% decline from the peak. It'll probably be, another couple of years until this completely plays out. We'll have to see what happens with the debts of the consumer and the debts of the United States, and to see what the migration patterns are to Florida, because we have a negative birth to death rate ratio here. So it can get really ugly pretty quickly if we don't get the migration that we need to our state to fill up all these houses that we're building. Then we see Texas, right? Austin, Texas is awful. The guys I hear there, rent prices are going down. Home prices are going down. It's not getting any better. It's actually getting worse every single month I talk to the number 1 home flipper in that area. And he's saying it's getting worse every single month. Even on the rental renewal, same thing here in Jacksonville. Rents are down about 10 to 15% from the prior year. So, it is across the board different in each area. So I would keep that in mind, and it won't impact your area differently. So divided Fed. This is what's causing the Fed to kind of figure out, hey, what do we do next? This data just came out. The Fed officials saw another two interest rate cuts by the end of 2025. That's what the minutes show, and they're concerned about the labor market. This is one of the reasons why we've seen interest rates fall recently, is because the labor market obviously had that massive write down of over 900,000 jobs, according to the BLS. Now the government shut down and they're not even releasing the data, but the stock market is celebrating because they're saying, if the labor market weakens, we might get more rate cuts here for longer, and that's fantastic for stocks. They can use those low rates to borrow lower and grow their businesses, and it's kind of like bad news is good news in this type of market, which is pretty interesting. And it's only going to get worse. So this is Fed Powell. Printer's coming. He's here to continue to drive the economy as far as he possibly can. He's been trying to resist, Trump's effort to get them to reduce the Fed funds rate even lower than it is right now. I think obviously if we did not have the government's intervention, the Fed's intervention with interest rates, having $2.3 trillion of mortgage-backed securities on their balance sheet, then rates could easily be in the 10 to 12% range, which would drive prices down another 30-40% from here, and that would be fantastic for the next generation and not so good for the generation that already owns real estate. And so you kind of have to decide as the government, who am I going to help out here? The older generations that have their homes, they're going to lose all their equity going into retirement, or am I going to make way for the younger generations by having rates go higher? And obviously the government has chosen, let's lower rates and continue to inflate assets, and the next generation is just going to have to figure it out. And that's why gold is telling us what it's telling us, right? We're trying to print our way out and try to grow our way out of our debt and our deficit, and the investors aren't buying it, right? That's why they're going into crypto. They're trying to go into gold. They're trying to find anything that's not USD, fiat currency, so that way they can avoid the depreciation of our dollar, which has already dropped 10% this year. And gold is telling us this. And I don't think, real estate used to be a great asset class to stay in during this type of, period where you could expect a little bit more like higher inflation and low growth. But the problem is that it's completely overbuilt in some areas and the migration isn't there. And also people are stop having household formation because it's too expensive to have kids. So, there's a lot of issues with real estate being a hedge against this type of period. We're also seeing on the rental side a lot of distress. Late payments continue to tick up. This was an incredible chart. It goes up about 2% in terms of late payments from the prior month, the prior quarter. And that is really important. I mean, you're talking millions of people who are late on their payments already, and we haven't even seen a crack. This is partly because we're starting to see, higher unemployment. We're seeing job openings decline. You can see that blue line there. That's the job openings decline. Unemployment is starting to, pick up a little bit. This is what the Fed is talking about. They're concerned about. It's a partly just the economic cycle. We obviously had the higher rates, but also the concerns about how AI is going to be playing into companies hiring, right? There's stories about, even companies that do a lot of coding, like 30% of their coding is already being done by AI. And so they don't need to hire as many people. This is a great chart that just came out. This is year-end repossession estimates, 2008, 2025. This is starting to show that the consumer is stressed, right? They bought these really expensive cars and they depreciated, and they can't make the payments anymore. And this is just as bad. If you look back, this is just as bad as it was in 2009, like almost as bad, 2008. And again, we haven't even started to feel like we're at record highs in the stock market, Bitcoin, you name it, gold, and the consumer just does not feel the same way that Wall Street feels. Wall Street and the consumer are completely on different paths. And consumer sentiment across the board is the lowest since the great financial crisis. So people do not feel good about the future or their jobs. And the consumer has loaded up with debt. I mean, look at this. The consumer has never been this much loaded up with debt, with credit card debt, student loans, car debt, house debt, all of it combined, they feel like they can't, there's no way out. Here's the credit card delinquency balances. You can see they're starting to spike up. We might get past the 2010 level in terms of the, and this just gets me crazy because I see the Klarna stuff, the buy now, pay later on everything. I'm like, who's going to be paying like 20% on their burrito they bought from Chipotle? It's out of control. And this is unpaid credit card balances for the last at least 3 months, rose the highest level in 14 years, which is obviously another red flag. So look, the consumer is stressed. Sellers are locked in, buyers are locked out. I'm just curious, what do you think will happen in your specific real estate market? Love to see you comment below. Do you think we're headed lower in prices? Do you think we're headed higher? My prediction is for Florida specifically, we're going to see a 31 to 42% decrease in prices from the peak in October 2022. Love to hear what your thoughts are. And how much do prices need to come down if you're a buyer for you to actually consider buying a home? Let us know. Like, comment, and subscribe. As always, you can follow my Substack as well. I'll put the link below. I talk about things there I can't talk about on YouTube. Appreciate you watching. I'll be in touch next week with more data. Thanks so much.